Most people think markets move because of bad news, a policy fight, a regulatory delay, banks arguing with crypto companies. Headlines appear, prices react, analysts explain it afterward. But that isn't usually how markets work. Markets rarely fear the news everyone is already talking about. They fear what most people haven't noticed yet. Right now, the loudest conversation in digital assets is about politics, legislation debates, banks pushing back on stablecoin rules, lawmakers running out of calendar time before elections. That sounds dramatic, and it is. But if you step back for a moment, something quieter is happening underneath those headlines. Regulators are defining how tokenized securities will be treated under banking rules. Major financial institutions are expanding access to crypto investment products, and infrastructure providers are slowly connecting blockchain systems to the plumbing of traditional finance. None of these announcements feel explosive on their own. No fireworks, no sudden revolution. Just technical adjustments. But markets rarely change because of dramatic moments. They change when the rules quietly shift in the background. And when those rules change, capital eventually notices. Before we talk about what this might mean, we need to start with something simpler. What actually happened? Over the past several weeks, a number of confirmed developments have taken place across regulation, institutional activity, and market infrastructure in the digital asset sector. First, negotiations surrounding U.S. cryptocurrency legislation have stalled. Discussions between policymakers, banks, and digital asset firms have focused heavily on how stablecoins should operate within the financial system. A key point of disagreement involves whether stablecoin issuers should be allowed to offer rewards or incentive programs that resemble interest payments. Banking industry groups, including the American Bankers Association, have expressed concerns that such incentives could encourage deposit movement away from traditional banks. Because negotiators have not reached agreement on this issue, progress on the legislation has slowed. Second, U.S. banking regulators, including the Office of the Comptroller of the Currency, OCC, the Federal Reserve, and the Federal Deposit Insurance Corporation, FDIC, released guidance related to tokenized securities. The guidance clarified that under current capital rules, an eligible tokenized security should generally receive the same regulatory capital treatment as its traditional equivalent. In practical terms, if a bond or equity security exists on a blockchain rather than in conventional form, the capital requirements applied to banks are intended to remain consistent. Meanwhile, institutional participation in digital asset markets continues to evolve. Financial firms such as Morgan Stanley have explored expanding crypto-related investment products for clients. Existing spot Bitcoin exchange-traded funds, including those issued by firms like BlackRock, have continued to see trading activity as investors access digital assets through regulated investment vehicles. Infrastructure announcements have also emerged. Crypto Exchange. OKX recently announced a strategic relationship with Intercontinental Exchange, ICE, the parent company of the New York Stock Exchange. The partnership involves investment cooperation and the potential development of regulated futures products tied to digital asset markets. At the same time, institutional trading platforms connected to digital asset firms are increasingly integrating with traditional clearing and settlement systems. These are the observable developments. Understanding why they matter requires looking beyond the announcements themselves. At first glance, the developments we just discussed may look unrelated. A stalled piece of legislation, a regulatory clarification about tokenized securities, a partnership between a crypto exchange and a traditional market operator. Different headlines, different actors, but financial markets rarely move because of one isolated event. What matters more is how these pieces interact. Start with regulation. Large financial institutions cannot simply adopt new financial technology because it appears efficient. Their balance sheets are governed by capital requirements, compliance frameworks, and supervisory expectations. If a new system introduces regulatory uncertainty, the cost of adopting it rises immediately. The recent guidance from the OCC, Federal Reserve, and FDIC addresses one specific concern: how tokenized securities should be treated under capital rules. By clarifying that eligible tokenized securities generally receive the same capital treatment as their traditional equivalents, regulators are reducing a potential friction point. Banks do not need to assume that holding or processing a tokenized security automatically carries additional capital penalties. This does not force adoption. but it removes a barrier that previously made experimentation more difficult. The second layer involves market infrastructure. Institutional trading is not built around individual assets. It is built around systems, clearing networks, prime brokerage services, derivatives exchanges, and settlement rails. These systems determine how transactions move through the financial ecosystem. When digital asset platforms connect to those systems, their role changes. Instead of existing outside the financial system, they begin interacting with the same operational infrastructure that supports equities, bonds, and derivatives. This matters because institutions prefer environments they already understand. The third layer involves access. Financial products such as exchange-traded funds provide regulated pathways for investors who are unable or unwilling to hold digital assets directly. Through ETFs, investors can gain exposure within existing brokerage accounts, pension mandates, and asset allocation frameworks. According to forecasts from Bloomberg Intelligence, institutional demand could continue expanding if regulated products remain accessible and market infrastructure stabilizes. These projections are forecasts from analysts, not confirmed outcomes. When these elements align, regulatory clarity, infrastructure connectivity, and accessible financial products, participation often expands gradually, not suddenly. Institutional capital tends to move cautiously, but once systems, rules, and access mechanisms begin aligning, markets sometimes enter a phase where adoption becomes less about speculation and more about operational practicality. Understanding the chain reaction is often more useful than focusing on any single headline. When people look at emerging financial technology, the instinct is usually to search for a moment of disruption, a single event that changed everything overnight. History suggests it rarely happens that way. Consider the transition from floor trading to electronic markets in the late 1990s. For decades, major exchanges relied on human brokers physically executing trades. It was loud, chaotic, and surprisingly effective. Many professionals believed that system would remain dominant because it had deep liquidity and established trust. Then electronic platforms began appearing. At first, they looked secondary, useful for smaller trades, but not capable of handling institutional scale. But once regulators recognized electronic systems as legitimate trading venues, and once large institutions began routing orders through them, adoption accelerated. Not instantly. Gradually, execution speeds improved. Transaction costs fell. Transparency increased. Over time, the old system became the exception rather than the rule. Another useful comparison is the rise of exchange-traded funds. The first ETF launched in the United States in 1993. For several years, it attracted relatively little attention from large asset managers. Mutual funds still dominated portfolio construction, and many institutional investors questioned whether ETFs could provide reliable liquidity. But as trading volume grew and regulatory frameworks matured, ETFs began offering something institutions valued: efficiency, lower costs, intraday liquidity, operational simplicity. According to data from the Investment Company Institute, ETF assets globally have expanded from tens of billions of dollars in the early 2000s to several trillion dollars today. That growth did not occur because investors suddenly changed their minds in a single year. It happened because infrastructure, regulation, and liquidity gradually aligned. Digital assets may follow a somewhat similar pattern, though with important differences. Unlike earlier financial innovations, blockchain-based systems introduce both new infrastructure and new asset forms. That creates additional regulatory questions around custody, settlement, and market oversight. So the comparison is imperfect. History does not repeat itself precisely, but it often reminds us of something important. Financial systems tend to evolve slowly until the moment when new infrastructure simply becomes easier to use than the old one. Professional investors rarely think in terms of a single prediction. Markets are complex systems. Too many variables move at the same time: policy, liquidity, investor sentiment, macroeconomic conditions. So instead of asking, what will happen, a more useful question is, what conditions would need to occur for different outcomes to unfold? With that in mind, there are three broad scenarios that could shape the digital asset market in the coming period. Bull case: for stronger market expansion to occur, several developments would likely need to continue. First, regulatory clarity would have to improve across major financial jurisdictions. The recent guidance from U.S. regulators regarding tokenized securities suggests that policymakers are beginning to define how blockchain-based assets fit within existing financial rules. If similar clarity emerges around stablecoins, custody standards, and institutional participation, large financial institutions may feel more comfortable expanding their involvement. Second, institutional investment products would need to maintain demand. Vehicles such as spot Bitcoin ETFs have already created regulated entry points for investors who cannot directly hold digital assets. Analysts at Bloomberg Intelligence have previously projected that institutional adoption of such products could grow significantly over time if liquidity and regulatory frameworks remain stable. It is important to emphasize that this is a forecast by analysts, not a guaranteed outcome. Third, infrastructure reliability would need to continue improving. Prime brokerage platforms, custody services, and clearing systems must demonstrate the same operational stability that traditional financial markets require. If those conditions develop simultaneously, digital assets could gradually become more integrated into institutional portfolios. Base case. A more moderate scenario may be the most consistent with how financial markets typically evolve. In this environment, adoption continues, but at a controlled pace. Regulators introduce incremental rules rather than sweeping reforms. Financial institutions experiment with digital asset products through partnerships, derivatives markets, or investment funds rather than direct balance sheet exposure. Infrastructure integration continues quietly in the background. Custody services expand. Settlement technology evolves, but the core financial system remains largely unchanged in the short term. Markets under this scenario may experience cycles of enthusiasm followed by consolidation. Prices may move in response to macroeconomic conditions rather than purely crypto-specific developments. This path reflects how new financial technologies have historically been adopted, cautiously, gradually, and within existing institutional frameworks. Bear case. A less favorable scenario would likely involve a combination of regulatory setbacks and macroeconomic tightening. If policymakers remain divided on key issues, such as stablecoin regulation or institutional custody standards, large financial institutions may delay further involvement due to legal uncertainty. Operational risks could also influence market confidence. Major security breaches, exchange failures, or infrastructure disruptions could cause institutions to reassess risk exposure. Finally, broader financial conditions play a role. If interest rates remain elevated or global liquidity tightens, capital may shift toward traditional safe haven assets such as government bonds. In those environments, emerging or speculative asset classes often experience reduced investment flows. Under those circumstances, digital asset markets might continue functioning, but with slower institutional growth and more limited capital inflows. None of these scenarios represents a definitive prediction. Markets rarely follow a single path. Elements from each scenario often appear at different times as conditions evolve. What matters is understanding the range of possibilities and the conditions that would move the market toward one outcome or another. When markets become noisy, I try to narrow my focus to a small group of indicators that tend to influence capital flows across all asset classes. The first is the US dollar index DXY. The dollar plays a central role in global liquidity. When the dollar strengthens significantly, financial conditions often tighten. That environment can make risk assets, including equities, commodities, and digital assets, more volatile because global capital becomes more cautious. The second indicator is U.S. Treasury yields, especially the 10-year yield. Treasury yields act as a benchmark for the cost of capital in the financial system. When yields rise, investors can earn higher returns from relatively low-risk government bonds. In those conditions, some capital tends to rotate away from higher-risk assets. Another factor worth monitoring is inflation data, particularly the Consumer Price Index, CPI, and the Personal Consumption Expenditures, PCE Index. These reports influence expectations around monetary policy. If inflation remains elevated, central banks may keep financial conditions tighter for longer. If inflation moderates, policymakers may gain more flexibility in adjusting interest rates. Inside the digital asset market itself, two indicators stand out. First is trading volume and liquidity across major exchanges. Healthy markets typically show consistent participation from both spot and derivatives traders. When liquidity falls sharply, price movements can become exaggerated. Second is derivatives positioning, especially open interest in futures markets. Large shifts in leveraged positioning sometimes precede short-term volatility as traders adjust exposure. None of these indicators guarantees a specific outcome, but together they provide a framework for understanding the broader environment in which digital asset markets operate. Watching these signals often tells you more about where the market might be heading than reacting to the latest headline on social media. Financial markets rarely move in straight lines. They move through cycles: experimentation, regulation, adoption, and adjustment. What we're seeing in digital assets today appears to be part of that process. Regulators are beginning to define rules. Financial institutions are testing products. Infrastructure providers are connecting new technology to systems that global markets already rely on. None of this guarantees a specific outcome. Some developments may accelerate adoption. Others may slow it down. That is normal whenever financial systems encounter new technology. For investors and observers alike, the most useful approach is often the simplest one. Focus on verified information. Watch the indicators that influence liquidity and capital flows. Stay patient as the market evolves. This isn't investment advice. It's simply how I'm reading the market right now. Cautiously, analytically, and with a long-term perspective.